Somehow you've made it this far in life, paying bills, surviving grocery runs, maybe even keeping a houseplant alive for longer than 2 weeks, without ever truly understanding what a mortgage is. No judgment. Honestly, respect. But today that changes, because I'm going to walk you through the whole thing as if you just learned what money is, and by the time we're done, you'll be able to casually drop mortgage terminology into conversations and watch people's eyes glaze over in genuine admiration. Let's set the scene. You've decided you want a house, not an apartment, not a room with a hot plate, a real actual house, front door, backyard, a kitchen where you can pretend you're going to cook elaborate meals. You pull up the listing. You see the price. Your soul quietly leaves your body. This house costs an absolutely absurd amount of money. We're talking numbers that make your bank account laugh nervously and look away. You check your savings. There's enough for maybe a nice dinner and a streaming subscription. That's it. The house costs approximately $1 million, times more than everything you currently own. So what do? You go to the bank. A mortgage is simply the arrangement where you walk into a bank, sit down across from someone in business casual clothing and essentially say, "I would very much like to live in a house that I cannot pay for. Would you mind covering it? And I'll sort you out gradually over the next several decades." And the bank, which, let me be clear, is not your friend, not your family, not a charitable organization, looks at your situation and says, "Sure, we'll pay for the house, but you're going to pay us back slowly, over a very long time, and you're going to pay us back considerably more than we gave you." That last part is the part nobody really warns you about. Let's use an analogy. When you were little, maybe you desperately wanted a giant, ridiculously expensive toy, something that cost way more than your piggy bank could handle. So you went to your older sibling or a parent and begged them to buy it. They agreed, but you had to pay them back from your pocket money every single week, for years, possibly until you left for college. That is a mortgage. The bank is the older sibling. The house is the toy. Your paycheck is the pocket money. And this arrangement lasts not months, but decades. Now let's get into the actual vocabulary, because adults invented complicated words for very simple things, and you deserve to understand them. The principal. The principal is the base amount of money the bank actually hands over to buy your house. If the house costs $400,000, then $400,000 is your principal. It is the real number, the honest, straightforward cost of the actual property. Everything else we're about to discuss gets piled on top of this number like toppings on a pizza you didn't fully order. Remember the principal. It's the one figure in this entire equation that is purely about the house itself. Everything else is the cost of the arrangement. Interest. Now here is where the bank starts having a very good time at your expense. Interest is the fee the bank charges you for the privilege of using their money. Think of it like this. The bank is renting you a large pile of cash. And just like renting an apartment, you don't just hand back the keys and call it even. You pay for the time you had it. Back to the toy analogy. Your sibling buys the toy for you and says, "I want my money back every week. And also, for every month it takes you to pay me. You owe me one chocolate bar." That chocolate bar is interest. Seems minor at first, but you're paying this back for 30 years. That's 360 months. That is 360 chocolate bars. You did not budget for 360 chocolate bars. Here's the part that will make you stare at the ceiling at night. In the early years of your mortgage, the vast majority of your monthly payment is going straight to interest. Straight to the chocolate bars, while barely a sliver chips away at the actual loan amount. You'll be making payments for years before the principal moves in any meaningful way. It's uncomfortable to look at directly. I recommend not looking at it directly until you've had coffee. The down payment. Before the bank agrees to any of this, they want proof that you're a functioning adult with some financial discipline. They want skin in the game. They want to see that you have actual money of your own. The down payment is the lump sum you contribute upfront from your own savings before the bank covers the rest. Going back to the sibling scenario, before they buy anything, they ask to see how much you've already saved. You pull out your piggy bank and tip out $150. They take that, put it toward the toy, and now they only need to cover the remaining amount. The larger your down payment, the smaller your loan. The smaller your loan, the less interest accumulates over time. Less interest means fewer chocolate bars going to your sibling, and more of your money actually staying with you over the long run. A strong down payment also signals to the bank that you're not the kind of person who makes large financial commitments and then immediately panics. It builds trust. It reduces their risk. And most importantly, it saves you an enormous amount of money over the life of the loan. Amortisation. This word sounds like something invented specifically to make you feel confused. It isn't complicated. It's just the repayment schedule, the full breakdown of every single monthly payment you'll make across the entire life of the loan. Your amortization schedule is essentially a very long, very sober spreadsheet that maps out 15 or 30 years of your financial life in rows. Each row shows you one monthly payment and tells you exactly how much of that payment goes toward interest and how much actually reduces the principal. At the beginning of the schedule, you'll notice something disheartening. An overwhelming share of each payment goes to interest, with only a small fraction reducing what you actually owe. But over time, very gradually, like watching grass grow, the balance shifts. More goes to principal, less to interest, until eventually you're in the home stretch and every payment is meaningfully reducing the debt. 30 years is a long time. You will age significantly during this repayment period. You will develop opinions about things you currently find completely uninteresting. The fact that this chart represents a legal commitment across that entire span of time is either deeply reassuring or mildly terrifying, depending on the day. Escrow. This one surprises people, but the logic behind it is completely straightforward once you hear it. Owning a house doesn't just cost mortgage payments. You also owe property taxes to your local government for roads, schools, public services, and you need homeowners insurance to protect against disaster. These are real recurring obligations that exist separately from your mortgage. The bank is aware that humans are forgetful, creatures with full lives and finite attention spans. If you forget to pay your property taxes, the government has the legal authority to seize your home. If your house burns down and you have no insurance, the bank's collateral disappears. Neither scenario appeals to the bank. So they set up an escrow account, a separate holding account they manage on your behalf. Each month, your payment includes a little extra beyond the principal and interest. The bank holds that extra amount in escrow. Then, when your tax bill or insurance premium comes due, the bank pays it directly from that account. You never have to remember. It's automatic. Think of it as your sibling saying, "I also know that you need to buy shelf brackets to mount this thing on the wall, and you probably need toy insurance in case the cat destroys it. I know for a fact you'll spend that money on snacks instead, so just give it to me monthly and I'll handle it." You're not paying extra in the grand sense. You're just paying your other bills in a more organized and honestly more foolproof way. What happens if you stop paying? This part is brief but important. If you stop making mortgage payments, the bank does not send a strongly worded email and hope for the best. After a series of warnings and a formal process, they exercise a right called foreclosure. They take the house back. You don't get reimbursed for what you've already paid in. You simply lose access to the home, and the bank sells it to someone else to recover what you owe them. It is entirely transactional. The bank has no emotional attachment to your home or your situation. It is a business protecting a financial asset. Foreclosure also causes serious, long-term damage to your credit record, the kind that follows you around for years and makes future borrowing significantly harder and more expensive. So the short version, keep paying. That's a mortgage. A bank buys a house you can't afford outright. You agree to repay them over a very long time, plus extra for the service of lending. You put some of your own money in upfront to reduce the loan. A structured schedule maps out every payment across the life of the loan. And a side account handles your taxes and insurance, so nothing important gets forgotten. It is a big, long, serious commitment. But it is also the mechanism through which most people ever own a home. And now you understand it completely. Which means you are, without exaggeration, more financially literate than a meaningful percentage of adults who are currently in the middle of one. You're welcome.